All right, so this is the home stretch of kind of talking about the balance sheet and related disclosures. And so this will should be a little bit shorter than the middle one. And hopefully we can kind of walk through the rest of this. And again, in class, of course, there's going to be questions and back and forth a little bit. And whenever I ask a question, if you pause the video and think about it, I think you'll be further ahead as far as trying to learn the material. But, I'm going to kind of walk through everything as efficiently as I can. Might be there for a second. All right, so let's talk about the notes. The first large note, and so if you remember when we looked at the target 10K, it's just true of any 10K. You have the manager's discussion first, then you have the financial statements, and then you have notes to those financial statements. And so we're going to talk about, sort of at least in general, is what you might see in those notes. And probably the biggest one is what we call summary of significant accounting policies. And so what does that mean? And so US GAAP affords a lot of flexibility in using different methods. So as an example, with inventory, you can use the LIFO method or you can use the FIFO method. Sorry, my brain's blanking on some of the other things, but there used to be different ways that you could account for stock options. So you might use the intrinsic value method under the old system, or you might use the fair value method. And so anytime there's flexibility in the method that you might want to use for a particular accounting treatment, the significant accounting policy is going to discuss that. Rev rec is kind of a big one as well, where they're going to discuss the way that you recognize revenue. And the big thing is, I do want to highlight, is it does enhance comparability. If you remember, comparability was a qualitative characteristic in accounting. Now, it was not a fundamental qualitative characteristic. It was an enhancing one. But being able to compare financial statements over time within the same firm or compare one firm to another is very important. And so if I want to compare two companies, both who have a lot of inventory, it would be very important to understand whether they're both using FIFO, or if one's using FIFO and the other's using LIFO, whatever it might be. It really is important to have that disclosure. Another note or another discussion that it might have is what are called, subsequent events. And what happens is, you have a financial statement date. You might have a balance sheet as of 12/31/2022, and then it may not be made public or reported to shareholders until February or even March. And so things happen in between the end of the year and when it's actually made available and for external review. And so if anything significant where it's a material event where someone would make a different decision or believe something different about the firm based on that new information, you would need to disclose that in the subsequent events section. But again, it's a disclosure that is one that is very helpful. But a lot of companies won't have subsequent events, but it is something that's available as a disclosure. Okay, so let's talk about the MD&A, that manager discussion and analysis, which is really the first major section of the 10K. Usually it's, it can be 30 to 40 pages. And so there's going to be a lot going on within this MD&A. And there's a lot of accounting studies that look at MD&A disclosures and, what's the tone, how much detail do they give? Do they discuss, negative versus positive, all those kinds of things. And so this is an area of a lot of interest, whether it be financial statement users, whether it's creditors or debtors, or even researchers. This is something that there's a lot of analysis going into this. And especially now with the advent of a lot more analytics, when it looks at, being able to look at word counts and tone and being able to do some things that quite honestly, we probably couldn't do 10 years ago. It's beginning. I think there's a lot more coming out as far as the importance of the MD&A and how it's being used. And so, as you think about your career going forward, whether you are auditing an MD&A or whether you are preparing or whether you are having input as a legal counsel, whatever it is, please understand, I think this is becoming a more and more important aspect of financial reporting. All right, so when we talk about the MD&A, there's usually kind of 5 major sections that it's going to cover. And really the first one is results of operations. And so usually what you're going to see is a summarized or sort of a small version, or just sort of a quick hit of the operations. So you might have a brief P&L, you might have revenue trends, there might be some different things that it discusses, but it's going to at least summarize what it thinks are the most important aspects of the company's operations for the year. And we'll discuss liquidity, especially if there are liquidity challenges. They're going to make sure that they address those and talk through those. And it might be even at a minimum how they handle their working capital. What are their goals in terms of working capital? Do they want to maintain a quick ratio of 1? They want to look at a current ratio of 2. And it's going to kind of talk you through some of the liquidity aspects of the company and how they're managing their liquid assets and their current liabilities. We'll also talk about any capital resources that they have in terms of property, plant, equipment, or other resources that they're going to use to grow the business. And so you might talk about debt, some long-term debt, any major stock issuances. There's going to be a lot of things they're going to talk through in terms of what are going to be relevant to external stakeholders. Off-balance sheet arrangements. So this is one that sometimes there are things that are economically important, but not haven't risen to the level of needing it being required as a disclosure on the balance sheet. So you may have what are called these, basically off-balance sheet items, and so it could be something like maybe there's some legal proceeding that has gotten underway where there's potentially either something in your favor or against you, where there's maybe a likely settlement on the horizon, whatever it is, but it just hasn't come to the point where you need to disclose it on the balance sheet. But it would be relevant for people to understand what's going on, especially if you think about some of these companies have what I call kind of newsworthy situations arise. And so they might want to discuss those and sort of walk through those. Maybe there's a recall. Maybe there's just could be a lot of things going on that they need to talk through that aren't necessarily on the balance sheet, but are economically significant. And then finally, critical accounting estimates. Basically, are there some important processes that they have in place in the way that they're estimating certain items on the balance sheet, which would of course then affect the income statement. And so they'd want to discuss those, especially where there's judgment involved. They're going to walk through exactly how they applied their judgment and why they reached the conclusions that they reached. In addition to all of that, just also remember that the CEO and CFO must sort of verify, attest to the financial statements, and the company also must provide a report on their internal controls. And so all those things are going to be part of the MD&A. All right, so another, I don't know if you can see it. I may need to shrink this a little bit. When you talk about compensation of our directors and our top executives, there's always sort of the issue of where do you disclose that, how much do you disclose, how much should you pay, all these kinds of things. And so we're going to kind of walk through that a bit. And so first of all, the things that you should consider. One thing, especially in today's, I would say, Glassdoor environment, where information is just going to get out there as far as how much executives are being paid. You got to think you have employees, and if they're making $50,000 a year and they've asked for a 10% pay raise, which would be like $5,000, and your company systematically is saying no. And you're making 15 million and you just gave yourself $1 million pay raise, that might not be received well. So you got to pay attention to that. It's again, in this age of information being accessible, it seems like, from everyone, you need to pay attention to how much you're getting paid. Can you defend that? Would you be willing to defend it, to somebody who is making much less than you, and say, well, here's why I get paid, and here's what I had to do to get to where I'm at, and here are the things that I do to add value, and here's why you're able to make $50,000. And so all those kinds of things are important, but you need to be able to think through the fact that a lot of this information is going to be made public if you're a public company. Now, if you're not public, maybe it's not as big of a deal, but at the same time, I still would consider that pay gap. This is an important one too. So, compensation structure is something that, whether are you going to pay your executives cash? Are they going to get bonuses? Are they going to get stock options? Is there going to be restricted shares? Are there going to be other things that they receive? What sort of, are they going to get a car? Are they going to get access to certain things, whether it be some companies might have a booth at an NBA game or something like that. All these different things that you got to think what incentives are being created by that. And I think mostly about stock options and bonuses and things like that is you need to really carefully map those bonuses, especially to key performance outcomes. Make sure that you're incentivizing them to create value, not to just reach a number so they can extract extra money out of you. And even with stock options, you got to be a little bit careful, because whenever you think about the fact that for them the stock option has the most value in the difference between the strike price, which is the exercise price that they're given, and the market price when they want to exercise that option. And so think about it this way: if they know they're going to be granted a stock option, and let's say they know the option is not going to be vested for 2 years, well, they have kind of incentives to push the stock price down now, because that's going to lower their strike price, and then do something later to increase the share price. And if they're doing some sort of manipulation of the financial statements, or making some decisions sort of with their compensation in mind rather than shareholder wealth in mind, you have to be very careful. Now, I will say that the SEC and other regulators are being pretty diligent in trying to mitigate the ability for managers to manipulate stock prices to their advantage. But it doesn't mean that there aren't perverse incentives still there. And so it's something to pay attention to. All right, so where does this information get disclosed? This might be a good time to pause and kind of think through it. But the answer is the annual proxy statement. So the annual proxy statement is where the information is revealed. In certain situations, shareholders even get to vote on compensation, and for sure they get to vote on compensation committees for some, sort of either directly or indirectly, because a compensation committee is going to be a subset of the board of directors, and the shareholders get to elect the board. And so, if this information gets out and it's unfair, understand there is a trickle down. So just be aware of that. All right, let's talk about the auditor's report. There are 4 basic types. If you remember in chapter 2, we kind of really had 2 broad categories, but now we're going to be a little more technical in the way that we talk about them. First of all, the most common report is what's called an unqualified report. That basically means there's a clean opinion. They didn't see any issues to the extent that they were able to test everything. They feel comfortable that everything conforms to GAAP. I want to be very clear, though. An auditor does not look at every single transaction. They sample. And so this is based on their sample, based on their process. They believe that the financial statements conform to GAAP. It doesn't mean that they do, but it means that it more than likely does. And then there's also an unqualified opinion with explanatory or emphasis paragraph. And so what does that mean? It means still conforms to GAAP, so that's not the issue. But there are maybe some other things where there needs to be some special attention. And that could be a lack of consistency. Maybe you changed your accounting method, and so there'd be a lack of consistency. Maybe there's a going concern issue. You're concerned about the solvency of the firm going forward. Or maybe there was a misstatement of information that was in a prior report. And so what this type of opinion says is, hey, listen, this conforms to GAAP. We didn't find anything there, but there are some things you should pay attention to as an investor or creditor, in our opinion. And so it is unqualified, but it obviously is not as clean as just a purely unqualified opinion. And then you have a qualified opinion. And a qualified opinion, it means one of 2 things: either that for whatever reason they were not able to have a full audit. In other words, there was a limitation to the audit, or they believe that there was actually a departure from GAAP. So what's been reported is a departure from GAAP. Now, I will say, as soon as we get to sort of this line right here, this is the vast majority of what you're going to see. If you kind of fall below that, where you now have a qualified opinion, there's going to be one more that we have after this, but a qualified opinion, it means something happened where the manager and the auditor could not agree on a treatment. And so most of the time, if an auditor sees a treatment or an accounting choice which they believe does not conform to GAAP, they're going to go to management and they're going to tell them, hey, listen, we disagree with this choice. And then management is going to try to explain why they think it is the right choice. And there's going to be this tension. There's going to be this negotiation, for lack of a better phrase, between the two. And so that outcome is really a negotiated outcome. And so you could have an unqualified opinion where initially the auditor and the manager disagreed on a treatment. But through a negotiation, through a conversation, they were able to agree on a treatment. And so they could still render, as an auditor, an unqualified opinion. If you have a qualified opinion, it means for whatever reason, that negotiated process did not come to a resolution that both sides agreed on. And so management pressed ahead with what they wanted to do. And then the auditor is going to come and say, well, we don't agree with that. This does not happen very often. And a lot of times, if it happens, there will be a break in that relationship going forward. It's not a very common thing, but it does happen. And so you need to be aware of it. And then finally, the last category, which is, again, another negative situation, would be an adverse opinion or a disclaimer. It basically means not only does it conform to GAAP, but we think there's actually an intent to mislead, which is probably more common, is that for whatever reason, they just don't have enough information to do the audit. Either way, this is not a good situation. This is sort of what I call the big frown. Like, this is not a good day. And so very rarely you get an adverse opinion. If an auditor issues an adverse opinion, it's probably a lot of other bad things going on within this firm. So it's not a very common thing. Again, most of the time you're going to be up here. Sometimes you might be here if they don't come to an agreement. Very rarely will you be down here. All right, let's talk about the last major section, which is risk analysis. So how do we use financial statement information in order to analyze the company and its risks? And so again, maybe a good pause here. What are the two main types of risks that users assess? If I were in class, I'd be like, okay, does anybody know one? Obviously, there's no one on the other side of this right now, so we're just going to kind of press ahead. But default risk and operational risk. So default risk, again, is the risk that you're not going to be able to meet your obligations and you're going to go into default on them. And then operational risk would be a situation where just your operations are going to be impeded or going to be potentially in jeopardy, but not necessarily to the point of bankruptcy or default. It just means that maybe the future is not looking so bright as you had hoped. So what are the main tools? And there are, I think, 4 that are going to be listed here. The first main tool are called comparative financial statements. And so what a comparative financial statement is that you can compare this year's financial statements to either last year's or even much earlier to assess trends. And so, you want to look at, what's going on with our balance sheet. Is our cash balance as a percent of our total assets growing? Is it shrinking? Are we more or less leveraged? All these kinds of things that you might want to look at over time. And so you have, 2022 compared to 2021 compared to 2020 or even earlier, and you might kind of line them all up and compare them. Another tool is called horizontal analysis. And of course, horizontal, this way, it's, left to right. And again, what you're going to look at there is sort of this year over year change. And so, some sort of basis. So you might look at 2019 as a base year, and then you want to look at a balance of, let's say, cash. And you're like, okay, so 2019 would be 100%. And then maybe in 2020, it's 110%, which means that our assets our cash is 10% higher than it was in previous years. And then maybe it goes 130%. Okay, grew even more in 2021. And then maybe it dips down to 120% in 2022. And what it allows you to do is kind of think about it in terms of relative to this base year, what's happening to a particular account. And again, I'm using the balance sheet as an illustration, but you could do the same thing with an income statement item. And then a vertical analysis, again, this is up and down. This is looking at particular items from sort of a gross number. So if you're looking at the balance sheet, usually you're going to use total assets as the base. And so what's cash as a percent of total assets? What are receivables as a percent of total assets? What's my net property, plant, and equipment as a percent of total assets? Whatever it might be, or what are my liabilities as a percent of total assets? And so that's a vertical analysis within a year. And then, of course, on the income statement, you're going to use total revenue. What's my cost of goods sold as a percent? What are my operating expenses as a percent? On and on we go. And so I want to be clear, though, a lot of times you're going to use these in conjunction. So I might have vertical analysis, and then I might want to compare vertical analysis over years. And so I kind of combine the two to get a better picture of what's going on. It's not like there's just one tool. These are the tools we use together to assess a firm's risk. And then finally, ratio analysis, which is looking at particular things in relation to each other, where it might be important to kind of think about that. So you might want to take an income statement item like net income and a balance sheet item like total assets. And so, well, these are the assets that I have to use. What sort of return am I getting on those assets? And that's return on assets. It's a one measure. And so these items are basically, we're looking at their relative growth or their value relative to one another. And that gives us a picture of what's going on. And again, today we're not going to go through all the ratios, but we're going to kind of focus on two types. That's really where we're going to kind of complete this lecture, is looking at the types of ratios that we want to focus on. Liquidity ratios is the first one. Again, liquidity is a company's ability to meet its short-term obligations. The major one that I think most students probably have heard of is called the current ratio. The current ratio is calculated as total current assets divided by total current liabilities. But again, make sure it's clear here. It's current over current. And so what is the current ratio from 49 Company? Again, pause, go back and find the information, and then bring it back here and then pick it up. And hopefully then you picked it up after your pause. The current assets were 99,150. The current liabilities were 50,000 for a ratio of 1.98 based on, again, they use the ending balance. Now, that 1.98, I want to be clear what that means and what it doesn't mean. It's not good or bad. So 1.98, let's say that somebody else had 2.5. 2.5 is not necessarily better than 1.98. And 1.98 is not necessarily better than 2.5. Really, it's about context. Whenever you have ratios, it's not good or bad, it's context. And so what you could say, though, is 2.5 demonstrates greater liquidity than 1.98. So basically, a higher number means there is greater liquidity. Greater liquidity is good in some situations because now you have some flexibility that you might not have had before. But at the same time, if your liquidity is too high, you may be underutilizing your assets. In other words, you may be able to leverage yourself a little bit more. You maybe take some of those liquid assets and invest into some non-current assets so that you can grow the business more long-term. And so just to be clear, it's not better or worse. It's more versus less liquid. A higher number means you're more liquid, which means there's more flexibility. Again, that's not always a good thing because you may be underutilizing your resources. The next one is called the acid test or quick ratio. And this is probably a new term, this quick asset. Sorry, my cursor got a little off there. For most students, this quick asset is probably a new term. I want to be clear what that means. So a quick asset is unrestricted cash, short-term investments, and accounts receivable, or net accounts receivable. And so it's those first three that we talked about. And so it's just a subset. And so it's a more restrictive measure of liquidity. So it's communicating something very similar to the current ratio, but instead of all current assets, it's only capturing the most liquid current assets. So it's just a more restrictive measure. So for 49 Company, again, pause, look back, add them up, and then pick it back up here in a second. And so the acid test or quick ratio, again, we have our cash, short-term investments, and net receivables. For a quick ratio of 1.01. Notice it's less than 1.98, and in almost all cases it will be. The only situation would be, I guess they could be equal if a company only has these three assets, these three current assets, as far as comparing the quick ratio to the current ratio. But I will say, in this case, again, we cannot say 1.01 is good or bad. But what we can say is a higher number means there's more liquidity. And again, just like everything else, there are some companies where a low ratio is actually where they want to be because they want to keep, sort of keep really don't have excess working capital. But for others, maybe 1.01 would be too low. Maybe they do need more financial flexibility. And so, again, just to be clear, there's no defined amount that is exactly the way you should be. It's about context and comparison. Solvency ratios. So solvency is not just about those current obligations, but it is all of your obligations. So it's a broader measure of financial flexibility. The first one we're going to talk about is called the debt to equity ratio. So it's your total liabilities over your total shareholders' equity. What does it mean? And so it's really about the firm's capital structure. So how are you financing your assets? Are you financing them through debt, which would be your total liabilities, or are you financing them through equity, which would be your total shareholders' equity? And so this is a measure of financial risk. And so the higher the ratio, the higher the financial risk, because what it means is that my liabilities are increasing relative to my equity, which means I'm taking on more debt. So that means my assets are being financed through debt rather than through equity. And again, I want to be clear, higher does not mean worse. Lower does not mean worse. It's just different. It's just risk. And so in some cases, a company may need to take more financial risk. In other cases, maybe they need to take less financial risk. And so, again, it's not good or bad. It's just a measure of financial risk. Higher meaning greater financial risk. So for 49er Company, again, we're going to pause here and gather that information. And you can see that for 49er Company, the ratio is 0.349, which basically means for every dollar in equity, there's 35 cents of debt. And so again, higher would be greater financial risk, not worse or better. The last ratio is called the times interest earned ratio. This has some income statement items on it. Actually, it's all of our income statement items. And so we're going to kind of walk through this one a little more slowly. But basically it's, can you meet, sorry, I lost my cursor again. Can you meet your interest charges? In other words, can you maintain servicing your debt? It is another measure of financial risk. Now, in this case, though, the higher the ratio, the lower the financial risk. In other words, now I've got more, resources available to meet that interest obligation. And so really what this net income plus interest expense plus income taxes, really this numerator is income before interest and taxes. Because the reality is whatever your income is before your interest, that's what's available in order to meet that interest obligation, because you only get taxed after your interest expense. And so all that to say, the higher that ratio, now I'm better able to meet. So I have less financial risk. Again, it's not better or worse. It's just more or less financial risk. So the higher the number, the lower the financial risk. And so for 49er Company on the balance sheet, we don't have that information. So I gave it to you, where we see net income of $13,200, $750 in interest expense, and $2,500 in income taxes. So again, pause here, try to calculate this on your own. It shouldn't be too hard, and then pick it back up. And so you can see that the ratio for 49er Company is 21.93. 21.93. Okay. Last thing is I do want to talk a little bit more about financial leverage. So again, this isn't meant to be a thorough analysis of financial leverage because there's a lot going on and we could spend a lot of time talking about it. But I want to talk about some main takeaways. So in the book, there's a long discussion of financial leverage and lots of illustrations, and it can kind of make your head spin a little bit. And we got to make choices in what we cover in intermediate one, and where I kind of choose to kind of limit this is just in these main concepts. But I want to be clear, there is a connection between financial leverage and profitability. And one of those takeaways is, with greater financial leverage, your returns, whether positive or negative, are multiplied. So it's sort of like, I like to play golf. So I use golf as an illustration. So if I'm sitting on the tee box and it's a 400-yard par four, for me, I kind of have a choice. There's really three clubs that I might hit depending on the situation. I could hit driver, I might hit a 3-wood, or I might hit like a long iron. And each of them has their own trade-off. So the driver would be the most leveraged, the highest leveraged club to use. So kind of imagine the greatest financial leverage. Well, if I hit that driver pure, I mean, it's going to put me in a great position, maybe 120 yards out, to go into the green. And so now I've got maybe a gap wedge or something trying to get to that pin. And all of a sudden now I got a real chance to maybe get birdie or for sure par. And so that's a high risk or higher risk shot, but the payoff is there. The problem with the driver, though, is if I mishit it, it's not just going to go a little bit right or a little bit left. It's going to go a lot right or a lot left. And I could be in real trouble. I could be out of bounds. I could be in water, whatever it might be. And so instead of, maybe a bogey, I'm going to get double or triple bogey and then just have a train wreck hole. Whereas if I took like a 3-wood or a 3-iron, I might hit a long iron, I might be 160 out. And so now instead of being 120, I'm 160 out, and I've got to really kind of hit a better second shot. So the probability of getting birdie probably is off the table. Probably still have a good chance at par, but it's kind of a less risky situation, because if I mishit that iron, I'm not in the woods. Like, I'm going to be in the right rough or something like that. It's not going to be a train wreck hole. And so the same kind of true for leverage. So the greater leverage, if things go well, boy, they go really well. If they go bad, they really start to go really bad. And so it's really important you think about the role of leverage and how it can multiply those shareholders' returns. And then finally, this is something that is a little bit missed, but let's kind of think of an example and kind of give you an idea of what this means. Let's say that I had a project or a business idea where I knew my return on investment would be 10% year over year every time. Like, I know for sure I can get a 10% return. All right. So the question is, well, okay, if I have that opportunity, how should I finance that opportunity? Should I use my own money? Should I borrow money? What should I do? And the answer really is, if I could borrow money at any rate less than 10%, I should borrow the money. And the reason why is because now it's not my own money. I'm using somebody else's money to make money, and I'm able to pay back my debt and still keep the return. So essentially, imagine I could borrow money at 7%. If I borrow $1 million at 7% and I can get a 10% return, I just made that 3% difference. I just made, 30 grand. And I didn't use any of my own resources to do it, other than maybe my time and energy. And so the whole idea is leverage works as long as your outcome as long as your return on that, whatever you borrow, as long as your return on that is more than the cost. If the cost is more than the return, then leverage is going to work against you. And so you got to make sure that you understand, what is my cost of the debt and what return do I expect to get from that cost. If the return is less than the cost, then that's dead in the water right there. You can't really pursue that opportunity. But hopefully that helps. That is all of chapter 3 from the textbook, if you're following me in class. If you're not, that's just a snapshot of the balance sheet and the related topics. Sorry. Let's end this recording.